Welcome to the FNO Insuretech podcast, a place where movers and shakers from all points within the insurance ecosystem gather and discuss all things Insuretech. We talk about how technology and innovation are affecting and driving change in the industry. Here are your hosts, Lee Boyd and Rob Beller.
Hey, podcast world, welcome to another focused edition of FNO Insuretech, where we do another dive into the world of venture capital.
Yeah, VC, also known as VC.
You're so clever.
Well,
nothing gets past you.
I might coin that.
Do you have an initiative? Yeah, I think you'd be
You
the
think
first
it'll
one.
stick? Think it'll stick?
Well, seeing that it's never been used in the VC community.
Well, hey, look at you. I already got you on it.
Yeah, wow, that's amazing.
Pretty good.
I have Lee Boyd here with me.
Yeah, hi, everybody.
One of your co-hosts.
Yeah.
That's me, the other one.
Yeah. Would you stop eating?
I can't stop eating.
The audience does not want to hear you.
We're at a conference, ladies and gentlemen. We're at a conference in Los Angeles, California. We're at the CoreLogic Interconnect conference.
Yeah.
And they gave out little bags of popcorn.
Yeah.
That are like really good. They're addictive.
They're great. So you should save it.
I can't stop eating them.
But nobody wants to hear you eat it.
My eating popcorn has nothing to do with our session today. Or our episode.
It might have something to do with our ratings.
So
it has nothing to do
Lee
with
is
our
here with
session.
me, though. You'll hear in a minute that he's not on the episode because
I am not.
Because he couldn't make it. But we have with us today somebody who is a big shot in the Insuretech VC world. Max Chee from Aquiline is with us.
Yes.
And for those of you who are keeping score at home, you know the name Max Chee and the things that he's accomplished. The companies that he's invested in and helped foster are big names in the Insuretech world. And Max has been kind enough to be with us today and give us an interview.
That's wonderful. This is one that I really hated to miss. Sometimes the stars don't align and we can't be on. But Max, I apologize for not being here, but I am very excited to listen to this episode.
Well, we're going to hear a lot about how Max and his team at Aquiline approaches what they do, how they think about it, and how they go about not just having outcomes, but having really successful ones.
That's great.
So rather than sitting here listening to Lee eat popcorn.
I'm sorry, everybody. So rude of me.
We'll get to our interview with Max Chee, partner and head of Aquiline Technology Growth. Hey, everybody. We are here today with a very special guest without Lee Boyd, who couldn't be with us today because of a Christmas commitment. We're just before Christmas of 2022, and we're here with a guy that we've been chasing after for a while because he is what I might consider a luminary in our crazy little business. We have Max Chee with us today. Max is a partner at Aquiline and head of the Aquiline Technology Growth Fund. And with that, we say, welcome, Max. Nice to have you with us.
Thanks, Rob. Nice to be here.
Where are you today? Where do you come to us from?
I hail from Brooklyn, New York. Cold, rainy, and miserable today.
Is it? Yeah, I know. We have this bad storm works its way through the country. It's yours now, right?
That's right. That's right.
I have a kid that lives in Brooklyn, so love Brooklyn. It's great to have you with us. We're excited to explore a little more in the world of the VC today, what's going on, what's cooking, because I think a lot has changed and probably a lot hasn't changed. And we want to hear about that and what's going on and kind of get a reasonable measure of what's happening in the world of the VC today in the Insuretech space. And so let's start by asking you to tell us a little bit about Aquiline and what it is that you do there.
Sure. So I joined Aquiline in 2017 to launch the venture capital fund. Aquiline was originally founded in 2005 by Jeff Greenberg. And it started off as a private equity fund investing across financial services. And as I said, in 2017, I joined because they actually saw a need to have a dedicated fund focused on venture capital with a primary focus on Insuretech across the broader Fintech ecosystem. And so I thought it was a really exciting opportunity to launch the fund and go after what was generally a emerging or new market segment called Insuretech. So that's how I arrived there. My background is I've been in venture for, I like to say 20 plus years, but I actually started my career back in '99. So as we talk about this market, I've kind of seen a lot of different cycles actually. So interested to see where this conversation goes.
Let's just jump in on that. Do you feel like we're in a new cycle now?
We definitely are. I think we saw a pretty big run up in 2021, and we've seen the market really sell off, and we're still kind of experiencing the effects of that here in 2022. So I do think we're at a different time in the market cycle, and if you started this business after, call it 2011, 2012 in the last decade, you haven't really seen a major down cycle like we're seeing right now. So these are definitely interesting times to be a VC.
Right. One of the questions that I wanted to ask you was just that. If you'd come into your business at around 2010 or 11 up till today, it's pretty much been a party of growth and great results. But as we all know, they're not called business cycles for no reason at all.
That's right. There's no end of the business cycle or end of history or end of anything. It sort of comes back around and around. So
right. When there's an end of history, there will be none of us around here to talk about it. So let's talk about your particular role at Aquiline. What does it mean that you're the head of the Aquiline Technology Growth Fund? What's that encompass as far as your responsibilities and role?
I oversee the investment activities of the fund primarily, and that involves sort of the management of the fund, making investments, overseeing the team, reporting, fundraising, just all the aspects of running and managing a venture capital fund is part of my job description.
And you've been in Insuretech since before it was called Insuretech?
I'm not sure when it was called Insuretech, and I don't know if the E in Insuretech is going to survive, but I've always kept the E in there. I think Jay Weishaupt convinced me that the E belongs there, and unless you're from England or something, and then you take out the E. But to all my friends in the UK, hello. I'm not sure if I was there before Insuretech, but it was definitely there just right around the emergence of it, I think. Mm-hmm. I could probably count on one hand the number of insurance-related VC investments I had seen in my career. There were so few, so little over the sort of preceding time period. Mm-hmm. So I think 2017 was kind of perhaps that, or maybe 2016 was when I think the focus started to really turn to insurance and technology.
And so you've had a front row seat, really, in Insuretech. I mean, I would assume that a reasonable amount of your time is spent, or your team's time is spent, in just looking at company after company after company, pitch after pitch after pitch. Is that so? I mean, you've seen it kind of really grow and change in the last 5 or 6 years.
Absolutely. Me and my team, we've probably seen, over 500 companies at least, probably more closer to the 1,000 level, I think, in terms of just Insuretech businesses across North America, Europe, Asia as well. It's been pretty extraordinary how entrepreneurs have embraced the category in the space. So, and probably about time too, when you think about the size of the market, but it was just something that, most entrepreneurs started in definitely different sectors, even within financial services. They started with payments and banking and lending and other areas before they arrived at insurance.
Insurance lasts because it's just so much more complicated, unusual, different?
I think so. Complicated, unusual, different, maybe less obvious as a place to attack up front. At least from a consumer perspective, it's not something you see all the time or think about all the time, whereas, a banking transaction or a payment transaction is sort of like a daily thing from an engagement standpoint. Mm-hmm. But I think once entrepreneurs started saying, once you saw so much of the world become transformed by software and by digitization. And then you had entrepreneurs say, wait a minute, I'm still buying car insurance the way I did, 10
The way my
years ago.
grandparents did. Right.
That's right. And the whole idea. And so I think that's when Silicon Valley said, wait a minute, this is a $7 trillion space. And we're still doing things in such an antiquated fashion. We've got to figure this out. And the money followed. The VC money followed. The entrepreneurs came in, and they had conquered other parts of financial services, and they said, why not insurance? Let's figure this out. And I think they were probably undaunted, and by all the regulatory challenges and the nuances of the business. And I think if you're an entrepreneur, you have to be a little brave and a little stupid, right? You have to. And I mean that with all due respect, in the sense that you just have to kind of go for it and try to prove the naysayers wrong about how difficult the market is and try to attack it.
Do you also have to have good timing in this space? Like you said, you've seen 500, probably in reality over 1,000 different companies, hundreds and hundreds of companies. Do you look at someone and say, that's a fabulous idea, but it's not time yet? Or like that? Is timing important?
Timing is everything in venture capital. You could have a great idea, but the time just wasn't right. I mean, look at Webvan, grocery delivery, right? Or
right, right.
Pets.com, selling pet food online, right?
Mm-hmm.
Now look at delivery companies today, 20 plus years later. The technology has to be right. The market has to be right. Where you are, the adoption curve. But I think you make an interesting, the takeaway I get from that is, from a timing perspective, is, the technology's got to be there, right? The technology's got to make it easy enough to adopt, or it's got to be, faster, quicker, cheaper, et cetera, for there to be adoption. And, you have to have all these elements, correct for the timing to be there.
Right.
And some ideas, no one has a crystal ball. I think where we invest is sort of Series A rounds. So we want to have some evidence of product market fit. Seed rounds, as they're called, typically the entrepreneur is still trying to figure things out a little bit, right? Mm-hmm. Figuring out the product, how they get to market, how to design it. They may not have any sales yet. So could we say it's too early? Well, it's hard to say. I think when you're investing in the seed round, by definition, it's too early because they haven't sold anything yet.
Uh-huh.
But timing plays an important role in whether these things will scale and be really successful. Absolutely.
Uh-huh. I looked over the investments that you guys are currently in today and looked for, themes that, ran through them. It seemed to me like data was still a big emphasis for you. Is that correct?
When I started at Aquiline, and when I started sort of studying the market a little bit, we probably scanned through the first couple hundred companies or 100 companies in Insuretech, and you see the patterns start to emerge. And one of the big ones was data analytics. So if you believe, as Mark Andreessen said more than a decade ago now, that software is eating the world, the world will become increasingly digitized, increasingly measured. There'll be a huge tsunami of structured and unstructured data. And that would create new opportunities for insurance carriers, underwriting claims, all across the value chain of leveraging, new data and alternative data. And so we're still seeing that 5 years later. That's been one of the big themes that we've had.
You guys are in some companies that we've had on the podcast, really interesting companies like Fairmatic.
Yes.
We're huge Jonathan Matus fans, right? We had him on.
Is that how you pronounce his last name? I didn't know that.
Matus?
Yeah.
I believe so.
That's good. I keep calling him Mattis. I feel bad now. Sorry, Jonathan, if you're listening.
I know that his first name is not pronounced Jonathan, right? Jonathan. And we had him on, and it was like, he literally blew our minds. He's brilliant, right? And he was running this ZenDrive thing, but really working on Fairmatic at the same time. And that's a really, talk about data, talk about mountains and mountains of data.
That's right.
Fairmatic is really, what intrigued you about Fairmatic?
Well, I think the fact that coming out of ZenDrive, they had over 5 billion miles driven of data and behaviors over, what makes a safe driver, what makes a risky driver. And our view was that the combination of that data and how they could apply it in commercial auto, in their case, like commercial auto, would be pretty impactful on loss ratios and on driver selection and on business selection. So we saw, a very big space, also with secular tailwinds when you think about the proliferation and growth of delivery drivers, delivery vehicles, and last mile logistics. So you had that going for you. You had this sort of new trove of data that could be very impactful in terms of loss ratios, risk selection, pricing. You had a really strong entrepreneur in Jonathan who built a great team around him. And also the market itself, I think, was ready for something where, they couldn't sustain the historical loss ratios. You needed to do a better job of underwriting the sector. So there were a lot of good trends, both technology as well as what was happening in the market that made this an exciting proposition. So we co-led the Series A.
You mentioned, the strength of the entrepreneur. I've heard you speak before about the team and how important the team is. I'm sure that you've been asked the question, when you look at a new opportunity, what do you focus in on? And team is a very typical answer. But I heard you say about the team that there has to be the leader, the strong entrepreneur, the visionary, a strong technologist.
Right.
But now, and this is a newer answer in the last few years, there has to be deep insurance know-how and ability.
Correct.
Do you see that as something that has evolved with time with Insuretech? It seems to me that when we were early in our podcast, we would talk to people who didn't have an insurance person on the team, really. Maybe advisors, but not somebody on it. Today, it seems like that's a critical piece.
When VCs or technologists go to look at different sectors of the economy that they want to, quote unquote, disrupt, they want to see things differently, right? They want to reimagine the market. Like, let's reimagine how we do this process, or how we sell this insurance, or how we underwrite. And when you do that, that's great because you're not bound to the old ways of thinking. But what you found in insurance and Insuretech was you lose so much domain expertise if you don't have that person, that insurance veteran who really understands how the industry works. Because you can't there's no such thing as disrupting insurance. You just can't. It's just too big. It's like disrupting Earth. What does that even mean? You can disrupt discrete elements of the insurance process, but you can't disrupt insurance. And so I think what you learned over the last few years is that these entrepreneurs, if you're going to think to yourself, I'm going to reinvent insurance, and I don't need anyone in insurance to tell me how to do it because they're kind of the old way of thinking and we're the new way. I think you're just going to burn through a lot of cycles. You're going to make a lot of mistakes. And then you're going to arrive at a place that took you much longer than if you had someone who's, smart, resourceful, practical within the insurance industry, with a network and the understanding of how things actually get done. Mm-hmm. Now, the trade-off is maybe you don't have this sort of big bang moment, right? And so it's always a balance between sort of entrenched thinking and this is the way it's always been done, you'll never change it, to, we really need to reinvent the industry or reinvent, so-and-so and try to drive it forward. But I think if you think about Insuretech and the evolution, I think it's leaning more and more towards having that industry expertise up front.
It seems to me like, and I'm interested in your take on this, that many Insuretechs are now trying to take a narrower bite out of the value chain, as opposed to solving the whole how do I disrupt insurance question.
That's correct. And we're seeing that in the companies we're looking at. I think when you start off, it's like, Healthion and WebMD. I don't know if you remember that. It's a very old reference, but there was a book written called the new thing about healthcare. And, the protagonist wrote in a napkin, like, healthcare, doctors, patients, a big circle, and then like $1 trillion. And that was his vision. This is a big market. We're going to disrupt it. And, insurance, $7 trillion. Woohoo! But I think once you get into the industry and you really understand how it works and how discrete a lot of the way that sort of the premium or the size of the industry is cut up, you just get more and more real about what you can or cannot do. I think in a way, the first wave of Insuretech was exciting because you did create these big bang kind of companies that really tried to disrupt these huge, big kind of markets, and they still may be successful. But I think when you take a more subtler look at some of the discrete problems, I think that's kind of where we are now in terms of Insuretechs, because they also recognize how hard it is to just go compete against the incumbents in these really big markets.
An example, not that they're a new company at all, is Cape Analytics, who is in your portfolio. They're not out to change the entire insurance industry, although Ryan might, argue with me about that. But they're solving a specific problem, right?
That's right.
It's a larger problem, but it's still a specific problem within the whole umbrella. They're not trying to restructure the umbrella. So that makes me think of MGAs, and I know that you guys have some MGAs in your portfolio, and some of the earlier ones in the wild days, they've made a lot of big headlines, but today it seems like they're struggling a little more. What's your insight there?
Yeah, we think a lot about that and about the MGA business model and what's working and what's not working. And, I think I'd go back to the example of Fairmatic, which we talked about earlier, which is an MGA that we invested in. And you look at the ingredients for success. So I think perhaps the many MGAs who started maybe didn't have as much of a competitive advantage or an edge that they thought, whether it was in distribution or underwriting. So, and in some cases, I think in the race to grow quickly, they maybe, overlooked some of the challenges around underwriting and losses and maybe, learn the hard way on that as well. And then also the reinsurance capital issue and making sure you had enough capital to grow your business. Those are some of the things that I think everyone kind of learned the hard way. But the fundamental premise of can technology really drive better outcomes for you and create new products? I think I still believe that. And I think because of that, I think there will be very interesting and novel MGAs that come out that wouldn't have existed were it not for the new technologies that are out there and what new technologies can bring. So a good example is parametric. So it's a very small market today, but we think it actually could go pretty quickly because it can solve new problems in new ways that previously couldn't be solved before. So MGAs are a good proxy in the industry for sort of new product innovation. That's how new products really get pushed out through these MGAs. So I think we're kind of medium long-term bullish, but I think we're tempered by the fact that if you talk to my colleague Jason Rotman, who is a president of Distinguished right now, an MGA, we'll have all these debates because he comes from the old school. And I sort of come from the new school. And the question is, what are these things? How will these things ultimately be valued? And I think we debate that all the time. And to me, if they're growing quickly with the right margins because of technology, then I think they will be more valuable. I think they merit sort of venture capital money. And that's my fundamental assumption for the space. So
interesting. Let's switch gears for a minute and talk about 2022. We're at the end of the year. I think it's probably a year that a lot of people in the world of finance are happy to see go. Share with us some insights that have come to light in 2022. We talked earlier that, we went through many, many years of a very go-go period of time where there was an abundance of venture capital and capital available to lots of entrepreneurs, and things are changing. Share with us from your seat some of the lessons from 2022.
Lessons learned are also sort of hindsight's being 2020, and I think easy to say now, but the valuations were unsustainable. So I think you had this place in the market where there was a lot of capital chasing investments in fast-growing companies, and a lot of discipline on valuations were sort of thrown out the window. And the valuation you would give on a company was based on the last valuation of the company that just got that valuation. And it just became this sort of up and up and up and up, right? Without any sort of thought for what could happen if the valuations turned or if the cycle turned. So the way the incentive structure works in venture, Bill Gurley writes a lot about this. He's a great thought leader in the space, a great venture capitalist would tell you that it's so driven towards finding that deal that a lot of people I think lost a lot of discipline in terms of the way they thought about investing and kind of what valuations they would pay for those opportunities. So I think it taught us that cycles do matter, that these things do turn. It's obviously hard to time it. We learned that these businesses don't go up and to the right, and venture capital can be a pretty tough business.
Has this year or the lessons, and they're not new lessons like you're saying. I mean, they're just this is the cycle. It's not a new cycle. But is it changing the landscape? Is the impact on the landscape changing? Ellen Carney from Forrester recently wrote an article where she said 25% of all insuretechs will exit this year for either acquisition or just running out of runway as a result of the economics that we're in. Do you agree with that? And is that a landscape change that we'll be looking forward to in years to come?
I don't believe that's the case, because the math wouldn't support 1/4 of all businesses going, flaming out. I don't think that even happened during the dot-com crash. We do have to remember, though, that 80% of venture businesses aren't expected to survive or to generate the returns from the investor that they expect. So by definition, these are very high risk business propositions, and you're proverbially swinging from the fences. So you're going to expect attrition. It's kind of ironic when you think about, I'm not sure if ironic is the right word, but you think about the insurance industry and you have a New York Life that's been around for like 150 years, or
right.
Northwestern Mutual, et cetera.
Right.
These not all insuretechs are expected to survive, and no one should expect that. So it sounds shocking to think, oh my goodness, 1/4 of all these companies will fail, but actually that's if only 1/4 of the companies failed over the next 5 years. That's actually a pretty good batting average.
Has your thesis changed at all as a result of the change in macroeconomic environment?
The thesis around what we invest in or what we want to invest in?
Yeah.
Well, I think we want to be a partner to the insurance industry, and at Aquiline, we have a lot of terrific partners and investors. And what we're trying to do consistently is invest in companies along the insurance value chain that drives greater efficiencies, productivity, cost savings, whether it's through, better distribution, better underwriting, claims, et cetera. So, I think these challenges sort of survive any cycle. So, and technology by definition is something that, will survive every cycle, because technology is just sort of what's new, right? Like Ford was a technology company.
Right. Right.
at some point in time. IBM
Right.
was a technology company.
Right.
Maybe
New
still is,
tech.
I don't know.
Right.
Yeah, new tech. Yeah.
Mhm.
So I think there'll always be the need for technology enabling productivity and innovation in any
Mhm.
industry, and especially in insurance. But I think when we look at new investments, we want to make sure that it has a strong ROI, that it has some resilience so that they have the capital and the value proposition to survive a down cycle, if you will. But fundamentally, the idea that we're investing in technology companies that can drive secular change in an industry should be able to sort of transcend the ups and downs of a cycle.
Mhm.
So that's really, theoretically how we think about our investments. And if we're investing in companies that drive real value to the end customer,
Mhm.
then arguably we should be okay. We just have to be careful because I think in some markets like this one, that end customer is, less likely or is more cautious around trying out new technologies, or they may not have the same kind of budget that they did a year ago to try new technologies.
Do you feel that you're at a little bit of an advantage in the insurance market because it is kind of by its nature a little more stable? It's not, all over the place. There's not wide swings. It's mandated in so many ways and in so many arenas that and it's stable and constant, and the product is basically always similar. Is that an advantage?
It's a really interesting question. I think because there's not as much price competition and pricing leverage, because the product is fairly commoditized.
Mm-hmm.
Not everywhere, but fairly. You maybe have less leeway to move about and to compete as a competitor. Now, as an enabler, like if you're selling enabling technology, then it's almost a good thing in the sense that, if I were selling to the crypto industry, I wouldn't be feeling really good about myself right now, or about the fact that I could sell to anyone who's still going to be around, right?
Right.
I know selling to an insurance company, there's a very long sales cycle, and decisions can get stretched out. But at the end of the day, we know these companies make great long-term partners, that they'll be around for a very long time, and there's needs that they'll continue to need to be serviced, and new products they'll need to purchase to deliver their service. So there's definitely some trade-offs in the space, but I think once you build a good customer relationship with a good product, I think that long-term relationship is very valuable. So I think it's better for the investor of enabling technologies in the longer term, perhaps, and it's tougher to sort of compete head to head in some cases then as a result.
So what's your opinion of this industry that we're in? You weren't always in it. You found yourself in the insurance world. I'm sure you're comfortable in it today. What are some thoughts on the industry that Insuretech is a part of?
Yeah, well, I like it. I think, at the end of the day, it's very sort of boils down to a lot of math, right? You're pricing risk, you're transferring risk, and you're trying to create these solutions that will, ultimately sort of, not sound too grandiose, but, help society move forward. And, I was talking to the head of innovation at Travelers about this. We're looking at things like, carbon insurance and carbon technologies. And, we all, have this sort of more of a collective desire to sort of reduce our carbon footprint to reduce the impacts of global warming and climate change. So insurance has an interesting role to play there. So I think in insurance, it's a slow moving industry, but it's also really, really fundamental. It's sort of very data driven and math based, which I like. It's very kind of complicated and convoluted, and really complex business to kind of understand. So firstly, I like all those things about the business, and I think it's sort of fun to try to really figure it out and be successful at it. But maybe I should be selling tokens on Terra Luna or something.
It's a tough industry to figure out. I mean, in the early days, we started this podcast because we were playing around trying to figure out where we work in the claims end of the equation, and we're trying to figure out what technologies we're going to win. And it's hard to figure that out. Sometimes the obvious ones don't make it. You know, you mentioned swinging for the fences in this business. I mean, do you have ones that come along that maybe they're not going to change the world, but I mean, maybe they're a single or a double, but not a home run. Do you pass on those because you can only ever see them being a double, or are they intriguing also?
I think it's how you define that sort of what does a double or a single mean to you, right? Because the market is, it sort of depends on the company you're investing in, what stage you're investing in, what problems they're solving. And just from a very practical matter, when we look at investing in a business, we say to ourselves, well, who's going to buy this business from us in 3 to 5 years? Obviously, we need an exit. We don't hold our businesses forever. We have a finite life to our investments. So we do think a lot about, would a double or triple, or if the business doubles in size, will we get a good return for our investors if we do that? And oftentimes the case can be yes, if the problem we're solving is very, is big enough, or maybe it's a very niche problem in a very big market. So, so I think it's okay to not necessarily play the power law of venture capital in certain circumstances where, you've got experts solving a hard problem in a well-defined market that they can go after, and it's well-sized and you can execute on it. And then, eventually grow the business and sell it to that next person. So, it's more of a kind of a growth mentality than a venture mentality, but I think that's perfectly fine and kind of works well in insurance, where if you're selling into the insurance industry, again, it's long-term relationships. These are annuity type kind of relationships.
They are indeed, and that's why we love it.
Yeah.
The relationships. My son is in the technology world, and his biggest customer one month might not be his customer next month, and that almost never happens in our business, in the insurance business. Certainly without notice, almost never. And so, kind of a different set of rules. I just want to touch on a couple more questions for you about Max Chee, the guy. So I read that you were involved with Spotify, Pinterest, LegalZoom. Is that all correct?
That's correct. My prior venture firm, we had made investments in those businesses, among others.
Is that where you learn your most lessons, on the big wins like that? I mean, those must have been, those are legendary success stories.
I think you learn from every deal and every investment you make. And I think the ones you're most proud of are the ones that you kind of fought your investment committee through and really had, personal conviction on what was going to happen. I'm proud of all my investments, but the ones that do well, you're obviously especially proud of. I think the ones you learn the most from, actually, quite frankly, are your failures, the ones you don't. But it's really amazing though to see companies scale and grow and really sort of really become successful. It's really gratifying to see that happen.
You must develop a gut for this, right? I mean, like you said, you've been at this for 20 plus years. It's more than just the numbers. You have to have a sense, more than the facts and figures.
Yeah, you call it pattern recognition. Like John Doerr, the legendary founder of KKR, who invested in Amazon, for example, he said, to be a venture capital, it takes about $100 million, right? You have to apprentice yourself and make $100 million worth of investments before you can really call yourself or have the experience to be a VC. In some ways, I believe that. Obviously, you can get lucky, right? And be at the right place at the right time, like we talked about. But I think to be consistently good, I think you do have to have a lot of pattern recognition. I think it's funny, Google tried to sort of turn venture into an AI decision-making tool to make investments, right? I mean, you can't do that in the public markets. What makes you think you can actually do that in the private markets, which is like much, much harder with a lot more human variables that, machines just won't, make it really difficult to understand. So that's why I like venture capital. There's a lot more, there's a lot of art and science, to your point. There's a lot of, trusting your gut, trusting your instinct, looking at different patterns, having a point of view, and, having conviction around, doing the work. So yeah, it's been a fun ride.
Where do you get your fun in your work? What's the funnest part?
I really think it's fun because you're really learning about these new businesses. You're learning, you're meeting these exciting management teams and entrepreneurs who have these like really exciting visions, and you're always learning about a new sector or a new space. So like I said, recently we've been spending a lot of time around, carbon accounting and carbon offsets and, that whole kind of world around emissions and climate change, et cetera. And, you're doing that one day, and then, maybe next week we're back to looking at blockchain again or something else. So, the fun part of my job that keeps it really light and refreshing is great ideas, great entrepreneurs, and, seeing that growth, and, no day being the same, because the companies we're looking at today could be very different from the companies we look at, a year from now. So I think there's always a sort of pipeline of interesting innovation that comes down, and that's never boring. That's always really interesting to me.
What does Insuretech 2.0 mean to you?
Well, I think the idea is, there's a first wave and a second wave, and there are a lot of mistakes and successes in the first wave, and you've taken that and you've kind of, you've tooled it, you've redeveloped it, and you've turned it into like, part two or the next chapter of the journey. So I think that's what, really that means for me. And for Insuretech 2.0, I think it's the idea that, we've learned a lot, made a few mistakes along the way, had a few successes, as you know, and we're going to iterate on that and, build a better sort of mousetrap for the Insuretech businesses that come out of this, this new wave.
What are your thoughts on cyber? Because there's kind of two parts to this. There's the selling of cyber insurance or the provision of cyber insurance, and there's all the infrastructure around it. Give us your thoughts there.
I think cyber is a really important area for insurance. I think it can't be ignored. It's a big area of risk that needs to be insured, and I think it can be insured. So I'm not of the camp of this is a systematic risk and we have to avoid it at all costs as an insurer. I think it's a really important category, and it's one that you can write insurance for and write it profitably. So I kind of have maybe a different view in terms of, not only the importance of it, but actually, does it work as a category within insurance? I certainly am, and I'm a believer that it is an important category and that it will work over time.
You guys have investment in the cyber area.
That's right. We're investors in Corvus.
And they're an MGA, correct?
That's correct, yeah.
So they're selling the product, the insurance product.
That's right.
I just find cyber to be fascinating and troubling all at the same time.
Why do you find it troubling?
It's a really tough bet. I guess you can write to the bet. You can write policies around the areas of most extreme vulnerability, but the vulnerability in cyber just seems larger than what we can even get our arms around. And that just seems daunting to me.
I think that it depends on what you're trying to prevent, right? Because I think with a lot of risk prevention, risk management, and monitoring, I think a lot of cyber attacks can be mitigated. And when we talk about MGAs and what MGAs enable, which is new product innovation, a lot of the MGAs in cyber, not just Corvus, but all of their contemporaries and peers, they have really good platforms for underwriting. They have really good platforms for monitoring. They really understand the emerging and evolving risks that are there. And they can proactively work with their business customers to, minimize the potential threat or attack threshold. So, when you think about it at the abstract, it is very, very scary. But I think that it can be sort of managed and mitigated, and hence, I think it can be and is proving to be an insurable asset class.
We can't have an episode like this without talking about COVID. It's funny, that's all we used to talk about. I mean, we have many, many, many podcasts many episodes where we talk about COVID a lot. We don't talk about it anymore as much, which is nice, which is for all of us who went through it, it's nice to feel like we're on the other side of it. Has that had an impact on you guys on a long-term basis? I mean, other than the fact that you work more from home, I mean, did it impact venture capital? Did it impact venture capital for Insuretech?
Well, I think it did. I don't think maybe not unique to insurance, but it really changed the way technology functioned within an organization and how you used it. And it also sort of exposed some of the areas of technology where things were just still really antiquated. Like I heard that, one carrier in all of COVID, the only team that had to go back in the office was a team that had to cut the checks out, to pay out claims, to their customers. Mm-hmm. And you're thinking to yourself, it's 2022. Why am I still cutting checks and sending it out in the mail? And so I think it really helped to accelerate and force the digital conversion in a lot of kind of workflows and work streams, and really emphasize the importance of technology investing. So I think for the insurance space and for Insuretechs, it maybe sort of help to crystallize the importance of digital transformation. In a world where it was much harder to be face to face, with your colleague or with a customer. So at the end of the day, it was probably from a business process and digital standpoint, it was probably a turning point. Although now we know the consequences of COVID and the Fed actions and inflation has caused sort of a bit of a mean reversion. Mm-hmm. But I think some of the things will still endure, like the fact that we'll all be in Zoom and we'll all have a kind of a hybrid workplace, and there'll be the requirement for more digital tools necessary.
We work almost exclusively with carriers, and like many large or very, very large organizations, they're trying to get back to the office. It continues to be a struggle. I think that the genie is out of the bottle as far as moving the workforce back into the office Monday to Friday, 8 to 5.
I mean, can you imagine if you started your career, people start their career now, how lucky they are not to have to commute 5 days a week? Is that amazing? I
mean, both of us, right? Both of us wouldn't be where we are right now.
Exactly.
If it wasn't for COVID. And now it's an accepted thing, but it does. And from our perspective as a service provider, we absolutely have seen how COVID helped foster adoption, foster the search for products that can help in all different kinds of places in the value chain. And I think that for the Insuretech world, it was a little bit of a gift. It was helpful.
Yeah, well, for the insurance world, I guess the question is, will they ever go back to the suit and tie? And then we all sort of, business dress, business attire. Because insurance is one of the last bastions of, you go to Lloyd's, you wear those really nice ties and stuff, and they look really put together.
From a product standpoint, and without giving anything away or even mentioning names, there must be areas or categories where you think, as you look out over the next 5 or 10 years, that are very exciting. Can you share any of those?
I think I alluded to some already, but I think everything to do with the sort of carbon economy and the E of ESG, I think, is really interesting. Dotted line to that, parametric is interesting. What other emergent risks will come out that insurance can solve or can tackle? So it's hard to say. I think a year from now we would probably be talking about completely different problems to solve and to tackle. Mm-hmm. So, but those ones are top of mind. I think we're seeing a lot of investment in alternative distribution, right? I know a lot of your guests have talked about embedded insurance and embedded distribution, but the idea of that, affinity-led type distribution, and then how agents use technology as well is, a lot of big investments there. You never talk about disintermediating the agent anymore. It's really about empowering the agent with technology. So, I think those are some of the enduring themes that we'll talk about, but near term, I see parametric and carbon as pretty interesting areas right now that we're kind of exploring and investigating.
Right. Yeah. It's interesting on the agent front. Years ago, when we started the podcast, people were after the agent. Now they want to partner with the agent and take care of the agent.
I guess so. I'm like, if I were a small business owner, I would still need to talk to someone. As much as, you're a millennial or a Gen Z and you'd rather just look at a TikTok video to get your advice, or, read a Yelp review if you're, a millennial, you still got to talk to these people.
Yeah.
It's not like you can automate a legal contract,
No.
There's some similarity. There's more, the analogy of a legal, talking to your lawyer or your accountant or your insurance broker. I think it falls more in that kind of realm of expertise in some respects, which makes it harder to commoditize.
Your doctor, your lawyer, your insurance agent, and your venture capitalist. Those are all the people that
will never be disintermediated. Never. You'll always need us. Like plastics.
And with
plastics.
And
crypto.
With that, and crypto. Yeah.
Long Bitcoin. No, I'm just kidding.
You just don't want to count how much is there today. Listen, what a pleasure to have you. Thank you. And for those of you who've listened, we've withstood all kinds of technology challenges to make it to through another outstanding visit with somebody who's really important in our industry, who you might not know and you might not ever have an opportunity to paths across. But Max is somebody who's literally making a difference every day by working with these companies and fostering them into the value chain. And so on behalf of the industry, thanks. And on behalf of our crazy little podcast, thanks. We appreciate having you.
Well, thank you very much, Rob. Really appreciate it, and happy holidays.
Oh yeah, same to you. Big thanks to Max Chee and the team at Aquiline for helping us to have Max on and continue our conversations with different people in the VC community. Very interesting, and we really appreciate it. Really appreciate all you who listen to our podcasts and by extension participate in them. So thank you. Thank you to Lee Boyd for absolutely nothing in not being here today to help, even though, truth be told, he's sitting next to me right now. And I'll say, until next time, goodbye, everybody.